All right, it was quite a positive start to the trading week for the equity markets here in India. And even if you take a longer term view, it's been a good month, it's been a good year, it's been a good couple of years for the equity markets. In fact, you look at the low point of last year for the Nifty 50, 7,511 or thereabouts, and we're very close to 17,700 for the Nifty 50. So what does that tell you? We're near all-time highs. What should your strategy be? That's going to be the focus of this conversation. It's also an opportunity for you to meet the fund manager, as this segment on TMS is called, on the Money Show is called. My guest is Canara Robeco's Head of Equity, Shridatta Bhandwaldar. Thank you so much, Shridatta, for taking the time, and a pleasure speaking with you. I do want to ask, in terms of what you're seeing in the recent past, over the past couple of months or so, some of the trends that are emerging, would you say that there is a rotation that is underway, that some moves are taking place from the broader markets back into large caps? How are you seeing the trends right now?
Thanks for this opportunity. So as far as the trend towards moving people moving some of the money into large caps is concerned, I think it will kind of be underway for some time to come. And the simple reason is not that there is a broad trend in place, but if you actually step back and actually look at what has happened over last basically 12 months, you had a lot of outperformance from mid caps and small caps. And it is an outcome of basically strong operating and financial leverage and growth that has come in the broader market. And that outperformance largely has played out over last 1 year. So gradually the thought process is till the time the earnings don't come in further and you don't get a kind of full picture in terms of how the broader economic upturn as well as the earnings revival is going to be likely to be for the broader market. Probably there will be some rotation towards large cap. But as of now, the jury is still not out. You need to see how the broader market earnings growth vis-a-vis the large cap earnings growth play out over next 1 to 2 quarters to make that judgment. But nonetheless, given the outperformance from mid and small cap over last 1.5 year, there is some rotation that is happening towards large cap from safety perspective at this point in time, rather than where the earnings are moving in necessarily.
Okay, I want to zoom in on your blue chip fund, Shridatta, because if I look at it over a 3-year period, if I look at it over a 5-year period, you are more or less in the top quartile of your peers in terms of performance, in terms of annualized returns. What, according to you, has led to that? Is it a different strategy that you have approached? Is it that your picks are slightly different? You have bet on a sector that other people have not bet on? How has it worked?
So as far as Canara Robeco blue chip fund is concerned, its strategy has been consistent through cycles over last 10 years. And broadly, let me take 2 minutes to explain the strategy of the portfolio, and that will tell you what is the difference that has happened over last 3-5 years. And that largely explains why you have that kind of outperformance vis-a-vis the peers as well as the indices. When you look at this portfolio, the construct is very simple. The basic strategy is you have a good composition of the compounding businesses and the alpha generating businesses. So there is a broadly 65-70% compounding businesses in this portfolio, about 30% the alpha generating businesses. And what do we mean by compounding businesses? Is basically the businesses where there is some form of competitive advantage, which allows, and there is enough growth opportunity that allows this basket of 70% of the portfolio to compound its earnings at anywhere between 10 to 15% to 17%, depending on the year that you are talking about. That gives a lot of base return as well as a lot of resilience to portfolio. So that's the one part of the portfolio which gives a very strong visibility on upside. It participates in upside to a significant degree, and at the same time actually protects the downside, because these are the businesses who are clearly leaders or challengers in their respective segments, and they're growing at a pace higher than the industry rates, and at the same time they are capital efficient. So that's the first part of the portfolio strategy, which is compounding businesses, which gives you base return and gives you downside protection. The second part of the portfolio is alpha generator. This is where you actually try to create significant alpha. These are the businesses where there is cyclical earnings upgrades, which is happening. And this can happen, this alpha generation in the earnings first and then the stock prices can happen for several reasons. There can be simply competitive dynamics of a particular sector is changing, and that's why your earnings are changing significantly. There can be a sector where basically the credit cost is cyclically going down, and so earnings upgrades are happening to a significant degree. There can be pure operating or financial leverage that is playing through in cyclicals. There can be balance sheet turnaround in certain companies. There can be capital allocation strategy changing or capital allocation methodology changing from promoters in certain businesses. And when any of these reasons happen, typically you get a significant earnings upgrade for 1 or 2 or 3 years in a particular sector or segment of the market, or even individual security. And that forms the next 30% of the portfolio, which we call as alpha generator. Once you get alpha in earnings, you get effectively that translating into the underlying stock prices, and alpha generation happens. So that's the two-part strategy for Canara Robeco Blue Chip. One is compounding steady, resilient businesses, which form 70% of the portfolio. Next 30% is basically businesses where cyclically earnings are getting upgraded for multiple reasons that I explained just now. So that's the combined strategy. As far as last 5 years and 3 years are concerned, in terms of sectors, I think capturing alpha in sectors like basically MNC pharma, capturing alpha in the injectables, and CSM players, capturing alpha in private retail banks, capturing alpha in insurance businesses, capturing alpha in basically gas value chain, capturing alpha in the select IT companies. So that has been one part, and at the same time avoiding a lot of businesses which were cyclically going through trouble, either on the P&L or balance sheet, particularly either in the commodity space or PSU space. Those avoiding those.
I take your point.
Combination of both these things have actually led to that outperformance.
Now, Shridatta, my next question relates to this. So if your strategy is 30% alpha generators, do you think that pool is now shrinking based on the kind of valuations that we're currently seeing? Are you uncomfortable with valuations in certain segments? And therefore, do you see that pool shrinking? How do we see the near to medium term?
So, particularly from near-term perspective, even on a broader market as well as in the large cap space, clearly, when you look at the Nifty valuations at whatever 22 times or 23 times financial year 20 earnings, it is clearly 1.5 to 2 standard deviation higher than the historical averages. And that clearly is a situation not to be very comfortable with in terms of what implied returns that you can get over next 6 months or a year, which is near term. Having said that, valuation is one part. When you look at the market, clearly you have to look at two things. One is what is the earnings cycle likely? What is the earnings trajectory likely over next 2 years, 3 years? And then the valuation, which is contextual and which will harm your near term, or which will mean that near term returns can be muted. So how we are looking at the market is there is an earnings upgrade cycle as things stand today, and as the environment is on external side as well as domestically. So there is clearly upcycle in the on the earnings part, but the valuations have clearly discounted significant part of it, at least from near-term perspective. And to that extent, clearly alpha generation on a broader basis at portfolio level basis will become a little more difficult, or rather, I would put it this way: that your implied returns in near-term will be a little muted, but the earnings cycle and business cycle is on the right side of the curve, and to that extent. One should actually look at market a little bit more from 2-3 years perspective at this point in time, and more through a staggered SIP route rather than actually taking a valuation risk at this point in time.
Shridatta, thank you so much for taking the time. It's been an insightful conversation, and wish you all the best. Look forward to speaking to you in the very near future.
Thank you. Thanks a lot.